What's up, traders? Ever stared at your charts wondering when to jump into a sideways market? Today, we're diving deep into the Bollinger Bands range trading strategy, a classic technique that's perfect for those choppy, non-trending markets. By the end of this video, you'll know exactly how to set it up, spot entry and exit signals, and manage your risk like a pro. So, how does it work? Imagine a channel that expands and contracts with market volatility. That's what Bollinger Bands are. They consist of three lines: a middle band, which is a simple moving average, and an upper and lower band, which are typically two standard deviations away from the middle band. In a ranging market, price tends to bounce between these upper and lower bands, like a ball in a hallway. Our strategy is simple. We aim to sell near the upper band and buy near the lower band. Let's get this set up on your chart. It's super easy. Go to your indicators and add Bollinger Bands. The standard settings are usually a 20-period simple moving average for the middle band and a standard deviation of 2. These settings work great for most situations, so we'll stick with them. The key is to find a currency pair that's trading sideways, not in a strong uptrend or downtrend. Look for price action that's moving horizontally, with the Bollinger Bands looking relatively flat and parallel. Now for the exciting part, entry and exit signals. For a sell signal or a short entry, we wait for the price to touch or even slightly poke through the upper Bollinger Band. But don't just jump in. We need confirmation. Look for a bearish candlestick pattern, like a bearish engulfing bar or a shooting star, right at that upper band. This tells us that sellers are stepping in and the price is likely to reverse back down. Once you see that confirmation, you can enter your sell trade. For a buy signal or a long entry, it's the exact opposite. We wait for the price to touch or dip below the lower Bollinger Band. Then, we look for a bullish confirmation candle, like a bullish engulfing bar or a hammer. This signals that buyers are taking control and the price is ready to bounce back up. Once you get that confirmation, it's your green light to enter a buy trade. So where do we take our profits and cut our losses? For risk management, a good place to set your stop loss is just outside the band you entered from. So for a sell trade, place your stop loss just above the high of your confirmation candle or slightly above the upper band. For a buy trade, place it just below the low of your confirmation candle or the lower band. This protects you if the market decides to break out of the range unexpectedly. As for your take profit target, the simplest approach is to aim for the opposite band. If you sold at the upper band, you could target the lower band. If you bought at the lower band, you could target the upper band. A more conservative approach is to target the middle band, the 20-period moving average. This will give you more frequent, smaller wins. You can even take partial profits at the middle band and let the rest of the trade run to the opposite band. It's crucial to have realistic expectations. The Bollinger Bands range strategy shines in sideways markets, but will not work well in strong trends. No strategy wins 100% of the time. You will have losing trades, and that's a normal part of trading. The key is to stick to your rules, manage your risk on every single trade, and only take high probability setups with clear confirmation. So there you have it, the Bollinger Bands range trading strategy from start to finish. It's a powerful tool for navigating those sideways markets. Backtest it, practice on a demo account, and see if it fits your trading style. If you found this video helpful, do me a huge favor and hit that like button and subscribe for more trading strategies. Let me know in the comments what indicator you want me to cover next. Trade safe, and I'll see you in the next video.